Okay, we're gonna keep knocking these babies out until they're absolutely done, and then we can put together all our stuff and it'll be really cool. Okay, so here's the next thing we're looking at, and it's specifically this index R2TW. R2TW. It's the percent of Russell 2000 stocks above a 20-day average, and this is an index that I guess is from bar charts, but it's really cool that they have it. As you'll see, it is it's a simple concept. It is very, very useful. Stocks above. Yeah, so you can get this with other stuff like S&P 500 stocks above a 50-day, stocks above a 200-day stocks. You know, you can get it for NASDAQ, Dow, S&P 600, just like basically any index. And wow, they even have 5-day average. Wow. Okay. Anyway, the one I just use Russell. There's some you could dig into really what the Russell is and whether that is a good idea or not to use that, but that's probably for another day. One thing you'll notice about this, yeah, so just to recap, so kind of in reverse order, this teal one up here is the S&P 500. I do have the interest rate behind it in a really dim red, just so I can kind of remember when stuff happened. This is the credit spread that we just talked about. This is the VIX credit spread in red, which is probably, to me, this is the most robust and understandable one. But this is like volatility complex, options, implied volatility, whereas the blue one is more like creditworthiness. And then this Russell one, so you're basically looking at a cross section of the index. So it's pretty cool because it's looking at 2,000 things and condensing it down to one number. Are they above or below the 20-day moving average? So I'm just going to go back through some recent examples of how you can put all these together and use them. So again, teal is credit, red is volatility, blue is, or purple is breadth. Sorry, I'm colorblind. I mean, just I don't want to go too, in reverse chronological order, but you can see in Liberation Day, and these don't match up vertically. The top one is kind of off kilter, but here's April 2nd when everything went to shit, and then here's April 9th when the president tweeted that we should all buy the S&P 500, right? So April 2nd, the credit spread goes up. It goes from 3.5 to 4.5 in one day, or a couple days. And then VIX goes from, it's the middle index. It was 0 here, and then it went to 7 here, which really that's meaning that the implied volatility of the front month is 7% more versus the back month, and it's only a 30-day difference. So it's saying like, hey, yeah, we think the volatility in the next 30 days will be 7% higher than the implied volatility in 60 days. It's a little much. And then here's the breadth. So the breadth, it's this far right index. You can see here it was in single digits. That's incredible. Out of 2,000 stocks, only 5% were above the 20-day moving average. That's if you zoom out all the way, that's like as low as it will ever go. single digits. You can see it only touched there in like, end of 2018, COVID, and here. Single digits is very rare for this index. And so the way I've kind of used it for myself is just whenever I see it go above 15, if it goes below 15 or 20 and then it comes back above 15 or 20, I kind of use that as the final trigger. So like, well, we see the VIX blowing out, credit spreads blowing out, breadth is in single digits. Wow, incredibly rare. When do we buy? So now you have VIX come back down, which kind of works for us as a signal, and the credit spread comes back down, which gives us confluence. It gives us context saying like, hey, is this a financial system thing, or is this just a volatility thing? Hey, they're both kind of together. Then you have this breadth finally, and this breadth here, I can't read that, but it was like below 5. Here it is 16. So like, you have this one day here, April 9th. The breadth suddenly gets above 15. It kind of draws back the next day. Then it gets above, it almost gets to 20. It's messing around. Finally here, April 17th, it gets above 20. So how does that align with the, indices? April 2nd, Liberation Day, the breadth goes down. April 9th, you have kind of this snap back, cough, cough manipulation. And then here, this is interesting to me because the index is going sideways, but the breadth is actually going up. Very interesting. And it finally gets above 20, and it's like, yeah, okay, generational buying opportunity, but it's hindsight bias. Well, here you can see the breadth just like absolutely skyrockets. It was, in single digits, it got above 20. Well, now it's all the way above 50 again. So half of the stocks in the Russell are above their 20-day moving average. And you can see that this kind of gives you a little more, I guess, confirmation if you need that for this to buy. But it's funny if you remember how people were thinking back in this time, in this 2-week period. It was like, oh my God, capital flight from the US. People are selling stocks, bonds, and currency. Like, no one's going to invest in the US ever again. It was like the end of the world, right? But you have these indicators chilling, and then the breadth rising. So is that only one cherry-picked example, or can you find other examples? Let's go back. I'll just do the reverse chronological order thing. So I always try to look at some main examples, like basically COVID and the yen carry trade blow up, the SVB thing, Volmageddon. And I have a very limited, experience of these different, I only have like 2 or 3 of those to go off of. So anyway, so the next one would be summer 2024. So interestingly, breadth was very high going into this. It was literally above 90, which is pretty incredible. I don't know if you use that as a complacency signal, because like here it was in the same place and it didn't really roll over, it just went up. But anyway, kind of, and with Russell, I think the small cap factor maybe an influence on it. Small cap and short squeeze. You gotta kind of temper it with that, I guess. But anyway, here it's mid-July. Ignoring the breadth thing, late July and then early August, this was like the peak of the yen carry trade blow up. you had the credit spread and VIX spiking. Breadth goes down to just about 10 or 11. It doesn't go to single digits again. Then you have the credit spread coming back, VIX coming back. VIX just absolutely dumps here. This is about 0 for VIX. So here it goes above 0, here it comes back down below 0. Very clean. The credit spread, there's 3 here, gets up to 3.9. That's a relatively mild move in the whole history of, credit spread moves. So it comes back about 0.5 percentage point. And then here's breadth. Breadth is, it kind of makes a bottom. It's coming up. Here it's 20, so it gets above 20. And here's where you are on the indices. So a second cherry-picked example, but it kind of shows how you can put these 3 things together. And then there's some other like oscillations in here. I think the key for this thing is like to really find the really obvious once a year examples. It's not to just like use it day in, day out. And the other thing about using the 20-day moving average with the breadth is that it kind of makes it this oscillation, right? Because it will always be moving that reference window forward. You could probably try to use it with a 200-day. I don't know. I'll look for that real quick. Russell stocks above 50-day. 5-day. Do they have 200-day? Yeah. Okay. Hang on. I'm gonna set these on their own scales, which will set off our little crosshairs even more. I'm not gonna look at all these, but I am curious. I feel like the 200-day one should be very informative. Oh wait, that was 20-day. Okay. Yeah, so like this one doesn't move as much. Here you had it. Oh my goodness. Oh my goodness. Yeah, so red is here. What is this? Okay. So red here, red went down to 15, and then it got up above 20 for the 200-day. And then here, what happened in the end carry trade? About here. You had this big spike here. It didn't go down that much because it's a 200-day window. Here, I guess you don't see what interest rates are doing here, but I think the market was pricing in expectations of hikes, at least in like the SOFR futures, and so maybe that explains this. I don't know. COVID. Yeah, I'm not gonna spend too much time on this. 20-day. This is a little more oscillating. Yeah, it's pretty clean. Or maybe that one's the 5-day. I don't know. Yeah, that must have been the 5-day because that one was really kind of crazy to look at. This one, I'm not seeing it. Okay, that one I'll just delete. I'll go back to the normal one. 20-day, it's fine, it works. yeah, anyway, where were we? We looked at Liberation Day and it was like, wow, that would have been perfect. And then we looked at the yen carry trade and we were like, wow, this would have been perfect. Going back to SVB and here. So SVB, the credit spread, this one's interesting because it was a relatively calm crisis. Like, it was just the regional banks and interest rate sensitive stuff that blew up. The index itself was relatively just calm. But credit spreads went from 4 to 5. VIX moved a bit, but VIX was relatively not like doing anything in this, right? Breadth was down around 10. Hang on, let me move these so I don't get confused. Breadth was around 10, so depending on what threshold you use, it's pretty great. And then by here it gets above 20, and then okay, generational buying opportunity, right? This is kind of different because it's like coming out of the bear market. And we can only know that in hindsight. But yeah, the key for this again is like you're looking for the once a year opportunities, which would be super obvious. And yeah, if there's some headline associated with it, like, you know, SVB, that was pretty obvious. Yen carry trade, I don't know if everyone was following that. I don't know how kind of aware the mainstream was of that. Liberation Day, everyone knew about that. And we have to look at COVID. COVID here, breadth is 50, so just normal. Late February, it starts rolling over, VIX starts rising, but what scale is this? This is 0, so VIX actually tapped above 0 in late January. Came back, I got fully above 0 in late February, but that was still very early to catch on to this. Credit spread is rising, the breadth is going down, the breadth, finally this thing takes off, so like the credit spread goes from 4.5 to like 6, 7, 8, 9, 10. VIX gets all the way up to 15% spread between the 2 months. This is interesting to me. VIX reverts here, and then the credit spread doesn't revert until later. Isn't that funny? I'm wondering if like let's check with the ETFs. How do I do that? Yeah, the ETFs match. Huh. Okay, anyway. This is just kind of funny to me. It's almost a week later. But it matches up perfectly with the bottom. The breadth is just as low as it's ever been. It's like as close to 0 as it could be. Hang on. Here the breadth is 11. Here it gets above 20. So you see this revert. You don't see this revert for another week. But by the time the credit spread is reverting, now you have the breadth. Breadth doesn't get above 20 until March 26th. So by March 26th, VIX is fully reverted. Credit spreads have just started reverted, and your breadth is finally above 20. So it's kind of like here, you're like, oh, maybe that was the bottom. It pulls back here, and I'm sure intraday this is like way more volatile. It's one thing to look at it now. It would have been a different thing to have been in the markets then. But by the time you see this breadth just take off and go back up to like 80 or 90, I guess it should be just a really clear signal that it's like, hey, now it's changed. Like the bottom is already in. But yeah, this one is a little interesting because usually the VIX and the credit spread kind of move together, but the credit spread was like way delayed this time. Yeah, and there's this little pop back here. I don't know, there's a little pop here, credit spread not doing much. But yeah, it never really goes back down to like single digits, then back above 20, which to me is like the trigger. This bear market here, this was really slow for the credit spread to move. VIX, it got above 0. It tapped above 0 here, here, here. Then finally it makes a peak and it reverts, and the credit spread reverts. This one is interesting because the breadth bottoms out into single digits and then gets above 20 by here. The breadth is going before the VIX and credit spread. So this seems like it's more just like an organic kind of sell-off, I guess. I don't know. But yeah, I guess that's a good example of like, it's not always just VIX, then credit spread, then breadth. It's like this one, the breadth is leading. And then, you know, you could almost use the breadth as an indicator just by itself. But the VIX and the credit spread give you more kind of dimension to it. Yeah, and beyond that, there's not much of this. The breadth one is an end of day value. So if you're using it based on TradingView, you'd have to like shift your values in your backtest. But I mean, there's nothing stopping you from calculating it in real time. Just grab all the 2,000 stocks of the Russell and do the calculation. And there may be places that publish it in real time. But yeah, that's probably my favorite indicator because I think it ties all this stuff together. There is one more to talk about, but it is kind of the cherry on top. With these three alone, I think you can kind of go to town very infrequently and once a year. Yeah, I think I'll do code for this one, but I will do that one later. But hopefully that helps show kind of the power of, you know, putting 2 or 3 things together, even if they don't work perfectly on their own. Yeah, that's it for now, and I'll follow up with the code and maybe what this looks like in a spreadsheet form later, because I kind of like looking at it in the spreadsheet form as well as the chart. Yeah, cheers.